Okay, so we are going to continue with our topic, sources of business finance. In our previous video, we talked about what finance is. We talked about why we need finance. We talked about sources of business finance, the meaning. Then we look at the classification. We classify them under two. The first one, the period for repayment. So we talked about short term, medium term, and then long term. Then we also look at where the money is generated from. So we look at internal and then external. Now we are going to talk about examples of the short term, medium term, and then long term. So let's start with the short term. We all know that when you say short-term source of finance, then it means that the period for repayment does not exceed 1 year. So that one is clear. So what are the examples? Number one, we have what you call bank overdraft. So we'll be looking at bank overdraft, we'll be looking at trade credit, and we will also look at short-term bank loan, so loans. Now, the bank overdraft and then the trade credit that I mentioned, they are exclusively short-term. Bank overdraft and then the other one, which is trade credit, they are exclusively short-term. When I say they are exclusively short-term, it means that they can never be medium-term. They can never be long-term. So you cannot be talking about long-term source of finance and then you mention bank overdraft. Neither can you talk about long-term source of finance and then you mention trade credit. We shall look at that one. And then I also said short-term bank loan. You see, so it means bank loan can be medium, it can be short, it can be long. So that is why we have qualified it with short to show that we are looking at short-term bank loan. So number one, bank overdraft. What is bank overdraft? Now when you go to a bank to open an account, the bank will ask whether you want to, which type of account you want to open. You may say you want to open savings account. You may say you want to open current account, and there are others. But these are the two main accounts. Now, if you open current account, then the bank will be giving you, or the bank will give you checkbook, so that anytime you want to go and withdraw money, you write it. You can go to the bank yourself, or you can give the check to somebody to go and withdraw the money for you. So if you're a businessman, and you have said that you often want to withdraw money as many times as possible, then it will be very appropriate for you to operate current account. Now, when you go to bank and you are operating current account, then that is where this facility, what is that facility? Bank overdraft will be available to you. So, this is how the bank overdraft operates. Let's say in your bank account, you have an amount of 10,000 Ghana cedis. But you want to buy an asset. You want to buy a machine, and the machine is going to cost you 15,000 Ghana cedis. So this is what you have in your account, but you want to buy a machine, and the machine is going to cost you 15,000 Ghana cedis. So, and where do you get the difference? So you can say that, okay, let me go for this credit facility we call bank overdraft. And it's because I am operating current account. So you go to the bank manager, you tell the bank manager that you want overdraft. They usually call it OD. Overdraft, bank overdraft. So the bank overdraft that you may want is the difference between the cost of the machine or the price of the machine, and then what you have in your account. So you need how much? This one minus this will give you 5,000 Ghana cedis. So this 5,000 Ghana cedis, you want it to be added to this one, the 10,000, to give you 15,000, so that you can withdraw the 15,000 Ghana cedis to buy the machine. So this 5,000 Ghana cedis is what they call overdraft. So this will be the overdraft. So when you go for the overdraft, the bank is going to charge you interest. So you pay interest. The interest is the cost of you being given the overdraft. And that will be reward for the bank. So the interest is reward for the bank, and it will be cost to you. So they will say that, okay, you are going to pay interest of, let's say, 25%. So 25% of 5,000, then you pay that interest. If it is per annum, depending on the period they have given. If it is 3 months, certainly it's quarter, so it will be divided by 4, and you pay that interest. That is what we call overdraft. So overdraft is a credit facility that a bank grants or gives to its current account holder to enable the account holder to overdraw his account. So the key word here is overdraw. Now what is the meaning of overdraw? Look at it. You had 10,000 Ghana cedis. So if you reduce 10,000 Ghana cedis, you have not overdrawn your account. If you had redrawn, let's say 8,000, you have not overdrawn your account. But you see, if you were given a facility that allowed you to redraw 15,000, that means you have overdrawn your account by 5,000 Ghana cedis. And that is what we call bank overdraft. So it is, you can get this facility to enable you to buy the machine. So if you come here, I have summarized it here. I said the bank overdraft, a current account holder is allowed to overdraw his account. Then he pays interest, and it is repayable within a short time. No bank will give you an overdraft, and then you are going, the period for repayment is going to exceed 1 year. No. You can be given overdraft, and within 3 months you pay. It can even be 1 month. It depends on the arrangement. You are a businessman. You have that the bank is there. So depending on the arrangement you make with, but it will not exceed 1 year. That is why we say it is exclusively short term. That means it cannot be medium term. It cannot be long term. So that is for overdraft. The next one is what we call trade credit. Trade credit. Now you go and buy goods from somewhere, you buy raw materials, then you ask the supplier that you cannot make immediate payment, or you don't want to make immediate payment. You want to postpone payment, you want to delay payment, and the person grants that facility to you. Then that is what we call trade credit. So you buy goods, but you don't make immediate payment. Payment is made in future. So you bought goods worth, let's say, 10,000 Ghana cedis. You didn't have money. Okay, the person allows you to go and use it, to go and sell. Then in a week's time, in 2 weeks' time, in a month's time, you come and pay whatever amount you are supposed to pay. That is what we call trade credit. And for trade credit, when the person grants it to you, the goods becomes yours. I'm saying this because we go to one of the sources we call high purchase. That's the difference between high purchase and trade credit. For trade credit, the moment the person grants it, then the goods becomes yours. So you go and sell, and then you make the payment. If you don't pay, in law, it is breach of contract. and the person will take legal action against you to pay the money, and if possible you may even pay what they call damages. So when you learn law of contract, you learn that one too. So that is the trade credit. So I said for trade credit, the person buys the goods but does not make immediate payment. And I said, if you don't have money, you can acquire the goods, you can have the goods. But if you have the money and you still want to pay in future, then it means you can use that money for other business operation, and that is why it becomes a source of finance. So if you have the money, you can use the money for other business operations. No interest, unlike loans and then overdraft. Here you don't pay interest, but know that depending on the person, the nature of inflation in the country, whatever, the person, you may not get it as the normal price. If somebody was buying something at, let's say, 5 Ghana cedis per one, they may give to you at 5 Ghana cedis, 50 pesos, 6 Ghana cedis, depending on the period. So that is for that one. And anybody who buys goods on trade credit will not get what we call trade discount. What is trade discount? Very simple. Somebody might tell you that if you buy goods worth 10,000 and you make immediate payment, he will give you discount of, let's say, 10%. So if that is the case, and then you bought something worth 10,000 Ghana cedis and you made immediate payment, and the person is supposed to give you 10%, that means you are going to get 1,000 Ghana cedis. But if you bought on credit, there is no way you are going to have it, the trade discount. So that is for the trade credit. The next one is short-term bank loan. Remember, I said bank overdraft is exclusively short-term. Trade credit is exclusively short-term. But loan can be medium, it can be long, it can be short. That's why we have qualified it with the word short. So short-term bank loan. That means you go for credit facility from a bank. Loan is a credit facility. Now, you may be asking, but what is the difference between loan and then the trade credit? They are both credit facilities. But whilst loans can be granted to both the savings account holder and then current account holder, or even non-customer. That means if you are not even a customer of a bank, they can give you loan. For bank overdraft, you are supposed to be a current account holder, then they will give you the bank overdraft. But they are both credit facilities. So it is the name, bank overdraft, whatever they want to allow you overdraft. The draft is checked. So you are allowed to withdraw more than you have in your account. So that is that. So short-term bank loan. So you go for this credit facility and the repayment period is short time. It is less than 1 year. So you went for loan. You didn't qualify for overdraft, so you went for loan. The loan, you will pay interest on the loan. And because it is less than 1 year or within 1 year, then you say it is short term and you can use it for whatever you want to use it for. So loan will be payable within a year and interest to it is paid. But usually, because the overdraft is shorter, relatively shorter than the loan, you pay more interest in respect of the overdraft than the loan. You know, if the period is longer and they are taking relatively smaller one, they will still get more from you. But if it is a short period, then the interest rate will be higher than that of the loan. So that is for that one. You can also get loans from private money lenders. There are private individuals who also lend money, so you can go to them. But usually you may pay high interest rates, so take note of that. Your friends may also lend money to you. And usually when friends lend money, they may not even take interest at all. So that is for that one. So that's for short term. Now, You may think that from short term, then the next one I'll be looking at will be medium term. No, I'll be looking at long term. Then after that, we may not even have to talk about the medium term. You know the reason. So let's look at the long term sources of finance. Very simple. Now remember, we have learned that when we say long term source of finance, it means the period for repayment exceeds 5 years. So it can be 10, it can be 20, it can be whatever. Depending on whatever you want to buy. You can go for loan and it's going to take you 20 years before you pay. And such one, they will certainly, you have to have an asset before they can grant that one to you. So I'm looking at long-term sources. The first one, debentures. We have learned it. So you know what debentures are. So I wouldn't waste much time here. You know that debentures are long-term loans that a company goes for from the public if it needs additional money to supplement its issued capital. In other words, they have issued shares. So they don't want to get more money through sales of shares. So they can go for loan from the public. This loan is not from bank, but from the public. So stock exchange. Remember when we were talking about stock exchange, we learned about that one. They can invite the public to come and give them loan. And then the period, they will keep it for a longer period. So remember we said for long, that one, it exceeds 5 years. And then they will pay you interest. Remember when you give, the debenture holder will be giving fixed rate of interest. We have learned it, so you know what is meant by fixed rate of interest. So in other words, if you gave it, and then let's say they are going to give you 5% interest on the debentures. If you give 10,000, then whatever that you are going to get to be calculated, and then it is given to you till the period elapses. When the period comes to an end, then you'll be giving your principal, then you cease to be an investor. So that is a way you can also invest in a company, but you will not be part owner of it. You have learned that one. You remember we said debenture holders are best described as creditors. So debentures are long term. Then ordinary shares. We are not going to waste time here you can buy shares in a company. Once you buy shares in a company, remember shares are permanent capital. We said when you buy shares in a company, especially the ordinary shares, you cannot return. If it is preference shares, they have what they call redeemable preference shares that you have already learned. That one, at one point in time, when the time elapses, you can return it and then you take your money. But if it is ordinary shares, you cannot return the shares to the company and take your money. We have learned from our topic on stock exchange that if you don't no more want to invest in a company, go to stock exchange, get a broker. The broker will get the shares and go and sell to another person who is ready to also invest. So ordinary shares are also long-term source. So that's why I've written here exclusively long-term. This is not medium, this cannot be short. This is not medium, this cannot be short. So that is for that one. Then you come to mortgage loan, or at times they say mortgage. It's loan. But that loan, it is called mortgage. You remember when we were talking about debentures, we said mortgage debentures, naked debentures. And we said for the mortgage debentures, there must be an asset as collateral security. So when you say mortgage loan, it means there are those loans that you need to use an asset, a property, before you can secure it. Before you can get that loan, you must have an asset. You must have a property that you use as security for the loan. So the property becomes collateral security. And that if you are not able to pay for the loan, then that asset will be sold. So that asset, you can never dispose of that asset until the loan has been paid for. So that is that. So that's why I said that this mortgage loan is the one that is secured by property or an asset that you use to secure it. And that property or asset becomes the collateral security. So it can be a building. It may be a piece of land or a vast land that you are using as the collateral security. Then the purpose, you get the loan. As a business, you must have the collateral security. Then when you get the loan, if you are not able to pay, then that asset can be sold to repay for the loan. That will give the poor the confidence to give that money to you. So that is that. So I said the borrower here, the business cannot dispose of the asset without first paying for the loan. And the moment they default in payment, that means if they don't pay, then the asset will be sold. The proceeds that you get from the sales of the asset will be used to pay for the loan. So that is for mortgage or mortgage loan. The next one is leasing. Very simple. Very simple, leasing. Now, you see, you have been hearing that, oh, I have rented a house. I have rented a room. That one is so clear to you. That is what we are talking about. That is what you call leasing. But the money you pay is rent. When you lease an asset, when you lease a property, what you pay is what you call rent. So the landlord, which we call leaser. So if it is leasing, we have the one we call leaser. Leaser is here. Leaser. We have the leaser. We have the leaser. The one who is giving you that property is called leaser. Then the one who is going for is the leasee. So in this case, the business will be the leasee. The business will be the leasee. Then the one who is giving you the land to build on. The one who is giving you the building so that you can operate your business. The one who is giving you the asset is called the leaser. So the landlord or the leaser grants the leasee exclusive and uninterrupted use. When we say exclusive, it means that the moment he grants you permission or he allows you to use the asset, there will not be any interference. You will be the only one to use it. So if the person leases a building to you, and then you are going to use it for, let's say, 10 years, you are going to use it for, let's say, 5 years, you use it uninterrupted. In other words, the person will not come and say that, I want to take my building, or, oh, I have this program, so please, let me use this building for that one. No. You use it exclusively, it cannot be given to any other person, and you use it uninterruptedly. So in a lease agreement, the leaser allows the leasee to have exclusive and uninterrupted use of the property that is leased. So that is for that one. Then you pay rent. You pay rent for the use of the land. You pay rent for the use of the building. Now let me tell you, you have been seeing contractors, road contractors. The big cars, most of them are using, they are not their own property. They lease them from other companies. Then they use for a certain period. Then after that, it is returned. So once you lease something, you have hired it, it is not yours. You have to return it in future. So that is for that one. So the money, you see, once you lease it, the money that you could have used to buy the thing outright, you cannot use the money to finance your business. That's why I said money that could have been used to make outright purchase can be reserved for other business operations. Then the disadvantage here is that if you are not careful, and then you practice this one leasing, the total cost for a certain period may be higher than where you have bought it yourself. So that is for that one. So that is for leasing. The next one, which is hire purchase, is very simple, straightforward. Now in hire purchase agreement, what happens is that somebody goes to buy something. Now look at it, two words. Hire. This word is pronounced in the same way we pronounce this word, hire. So hire purchase means you want to acquire an asset. Okay, you don't have full amount. Let's come back to this place. You want to buy something, it's 10,000 Ghana cedis. All that you have is 1,000 Ghana cedis. So you can go and see the person. The person will allow you, okay, make initial deposits, small initial deposit, let's say 1,000 Ghana cedis. Then to let it 9,000. The 9,000, the person will spread it over a period. Let's say 24 months, which will be 2 years. If it is 2 years, then it means it becomes medium term. If it is 5 years, it becomes medium term. If it exceeds that one, it depends on the amount of money involved, then it becomes long term. That is why I'm treating long term, because some of the long term sources that we are talking about, apart from the one we said, debentures, apart from the ordinary shares, all others can be medium term. So the moment we finish with this long term, it means we have finished with the medium term. The only thing is the period. So if it is loan and it is 2 years, then certainly it becomes medium term. If it is leasing and it is 2 years, it becomes medium term. If it is leasing, if you lease a piece of land to somebody for 20 years, then it becomes long term. So it's the period that will show you as whether it is medium or it is long term. So that is for that one. So in hire purchase agreement, all that you do is that you want to acquire an asset. It should be an asset. It should not be a consumable product. An asset. Because once you have not finished with the instrumental payment, the property belongs to the one who gave to you, the hire purchaser. It still belongs to the person. The hire purchasee, the product will become, or the asset will be his or her bona fide asset when he makes the last instrumental payment. So the 9,000 that we are talking about, the person can spread it and say that every month you are going to pay 500 Ghana cedis. If every month you are going to pay 500 Ghana cedis, it means it is going to take you 18 months to pay. If you pay 17 months, it is still the person's property. It becomes yours when you finish with the last instrumental payment. So that's why they say hire purchase, 2 words. The first part that you have not finished payment, you have hired it. It's like you have hired it. Then you purchase it when you make the last instrumental payment. So in a hire purchase agreement, the asset is acquired, you make initial small deposit, then the rest you pay in installment. So that is why I said the asset is acquired, then you make initial small deposit, and then the rest you pay in installment. It can be monthly instrumental payment. So the example we have already talked about, every month you pay 500. If you break that agreement, the person can come for the item. I think the person you may be asking is, what about the money you have paid so far? It will depend on the agreement between you and the person. The person may even look at the number of days the item must have been with you, calculate that each day is going to cost this. So at the end of the day, if the person is supposed to pay you something small, the person will pay you. Even if where you are also even supposed to add something, you will add, depending on the calculation that will go on. I remember long time ago, a friend of mine, not a friend, somebody that I knew, went to a place to buy fridge on hire purchase. When the person came, then I said, this thing you look at the I said, this thing that you bought on hire purchase, if you had bought the thing outright, it would have been better. Do you know that this is how much you are going to pay every month for this period? At the end of the period, this is how much you are going to pay. Now the fridge, if you are buying it, how much is it going to be? Then she said, this one. I said, you see. Then the person realized that she had made a mistake. So she asked them to come for the fridge. When they came, they looked at the number of days the fridge had been with her. Then they said they were going to pay her something. It was left with something small to be given to her. The fact of the matter is that she didn't go for what they were supposed to give to her because it was too small to waste her time to go for. So that's the disadvantage of it. If you are buying something on high purchase, you pay more. So you have to, but you see, the advantage is that you may not have the money to pay, to make abstract payment. And so high purchase will allow you to acquire it and use. You acquire and you use it. So that is a good thing about it. So that is for the high purchase. So I said the asset remains, or the asset remains the until full payment is made. The asset remains the property of the high purchaser, the one who gave to you. So that is that. Here I have already told you. The asset is required. An asset is required if full instrumental payment is not made. The person will come for the asset. The asset is not required. The asset is retained. It's retained. The asset is retained. The asset is retained if full instrumental payment is not made. So you retain it. The person will come for it. So long as you have not finished payment, it is still the person's property. So that is that. The next item that we are looking at is sales and leaseback. Sales and leaseback. What is sales and leaseback? Now, it's very simple. Look, we know what is sales. We know what is lease. So because we have done leasing. So sales and leaseback, when do you use it? Okay, you are a company, you have an asset. But you need money. You have a building, you have a machine, you have an asset, but you need money for something. Then you say, okay, why don't I sell this asset? And then after selling it, I will lease it from the person. That's all that says and lease back is. So this option will be appropriate for a company that has an asset. Sells the asset and want to have reuse of the asset, then you go for sales and lease back. So you sell. So this building that I'm even inside teaching, assuming it is mine, okay, I can decide to sell it. Now when I sell it, I get an amount. Let's say I sold it for, let's say, 50,000 Ghana cedis. So I'll get 50,000 Ghana cedis to do whatever I wanted to do with the 50,000 Ghana cedis. Then I'll lease it from the person and pay rent. So relatively, I'll be paying something small. If I say relatively, if I compare with the money I had, which is 50,000, then the rent I'll be paying will be small, so that I can use the sales amount for business operation. So that is what we call sales and leaseback. So you have an asset. I said you have an asset, then you sell it and leases it back. The firm loses ownership. So once you sell it, you are no more the owner. The one who bought it becomes the owner. So if the value of the asset appreciates, you don't have anything to do with it. It now belongs to the person, and you pay rent. So that is for that one. So that is for the long-term sources of finance. Remember, all these things we have talked about. If the period exceeds 5 years, then so if it is you sold to the person and you lease it back, and the person gave you, let's say, 6 years, 10 years, then it is long term. If it is high purchase and it is more than 5 years, it is long term. If it is leasing and it is more than 5 years, it is long term. But these same sources can be medium term. That means if the period is between 1 and 5 years. So that's why when you came to the medium term. Now I'm not going to explain these things again because they have all been explained. We have talked about leasing. So the difference is the number of years. So a land, a property that is given, that is leased for 2 years will be medium, 3 medium, 4 medium, and so forth. High purchase, the same thing. The period will determine that it's medium or long term. Sales and lease back, the same thing. Bank loan. A bank manager gives you loan and he says you are supposed to repay the loan within a period of 10 years, then it is long term. 2 years, then it means it is medium term. Mortgage to the same thing, it depends on the period. Usually it is long term, but if you go for that one and it is 4 years, it is 3 years, then certainly it will be medium term. So that brings us to the end of the examples of the sources. Short term, we have talked about it. Then we have also talked about long term. And then we also talk about medium term. Remember, all these ones have been explained. Our last subtopic is going to be the internal. We are going to look at the internal sources and external. You realize that almost all the external sources, we have talked about them, but we will look at it and then we introduce the internal sources. Until we meet again another time. Bye-bye.